Pinduoduo and Alibaba are the two biggest e-commerce players in China. And Pinduoduo owns Temu. They're cheap. They have grown massively. They have actually exploded in users. Alibaba has been around for a long time. They have other business lines, so they're more diversified. But they're losing market share to Pinduoduo. And in China, there is a huge e-commerce war going on. So from an investor perspective, how should you compare the two, and which one should you own if you should own any? Now, before we get into it, don't ever buy something because some guy on the internet tells you to buy something, or someone tells you this looks like a good investment. Do your own due diligence, do your own work, see if this fits your own style of investing and if it fits your portfolio. That's your job as an investor. Now, if this is something you're interested in, and if you want to understand stocks from a very fundamental perspective, the way Warren Buffett does, then you're here, then you're in the right place. Over here at Market Daddy, we do a live stream every Sunday. You can ask questions about your own portfolio, about stocks you're interested in, or if you have questions about investing in general, you can ask all those questions live over here to us, to me, to everybody here in the chat, to our community. And the second way we do this is by using our software. We buy validated data from a third party. It's the highest quality around. We have our own algorithm and AI systems doing a lot of the analysis work and the legwork for you. So you can quickly get an oversight of whether a stock is interesting for you, yes or no. Now, we'll be using our software every live stream. You can understand how it works, where the value is, but you can also try it out yourself. You can go to marketdaddy.ai. You can try it out for free for 7 days. If you don't like it, you can cancel anytime. We believe the software speaks for itself and you will be convinced, and you can use it as many times, as much as you want, and do your own stock analysis and put your money to work. Now, let's get into it. We'll be starting off by Pinduoduo. This is the new kid on the block. They own Temu. Always when we want to analyze a stock, we'll be asking our three important questions. Are we buying a great business? Are we buying a great business? Can we buy it at a great price? And can we reliably predict it for the future? Now, to answer these questions, we use our AI analysis. According to all of the great value investors of our time, they have talked about how they invest, what they look at in a business, and what they find important. And on all that data, our algorithm looks at the stock and sees whether or not all these great value investors would consider this a great business, that you can buy at a great price, and that you can reliably predict for the future. According to our algorithm, this is not a great business, but we can buy it for a great price and we can reliably predict it for the future. Now we get a quick overview of what they offer, and this due diligence is based on the last 5 earnings calls, or five quarters of earnings calls that they had. It scrapes all of the important information. It looks at how the management talks about their business, about the sentiment, and most of these earnings calls are sales pitches in disguise. But we filter through the noise and we get down to the meat and bones, and we summarize this to you in a very, very easy to read, easy to digest AI report. And you can take all the key highlights from this. And this data, again, is verified, is validated. You can rely on this. Pinduoduo makes e-commerce solutions for consumers and merchants. Their business model is focused on creating a robust ecosystem. They earn money through transaction fees, advertising, and merchant services. Yeah. They basically create a platform. Anyone who wants to sell goods can sign up to that platform and can sell their goods through Pinduoduo's platform. And Pinduoduo makes they charge a fee over every transaction that takes place on their platform. That's what they earn. That's where they earn their money. They can also offer extra services to merchants. This might be pay now or no. What is it? Buy now, pay later services. It could be inventory management. It could be creating a nice web shop. It could be any kind of service that they want to offer. And one of those, I think a big one of those is advertising. you can see it as a merchant service, but they define it as their own business line, and the merchants are paying for advertising for their products. That's how they earn money. Now, what is their competitive advantage? They have a solid edge through its extensive merchant support programs. The Renminbi 100 billion initiative shows commitment to helping merchants to thrive. This is the 100 billion initiative is something that Pinduoduo came up with, and they basically buy market share. That's what it is. They buy themselves into the market by spending a lot of cash. So merchants get attached to the platform, and the idea is that once a merchant is in your platform, he's very unlikely to go somewhere else. And they call it creating loyalty and strengthening their platform. Basically, they're buying users. Come over here, you get cash. Well, makes it very attractive. It's not something that you can maintain for the long run, because this is a cash bleeder. And from a business perspective, you want to earn money and you want to earn more than you spend. And the bigger that gap is between what you earn and what you spend, the better, the higher quality business you have. And this also shows whether you have a moat or not. If you have really high margins and you can get it to keep a lot of the money or a lot of the money from sales, you can keep in your own pocket without having to spend it on marketing, advertising, or these kind of initiatives, that makes you a higher quality business. They focus on high quality development for small and medium-sized enterprises. Their growth momentum is tied to strategic investments. They're willing to accept lower profits now for future gains. Their logistics support in remote areas and consumer campaigns. Yeah, they aim to drive sales and order growth. So they have a long-term vision. I always like reading that management has a long-term vision. I want to invest into a business for the long term. I want to put my money into the business and make sure that the business can run itself. I don't want to have to look at the ticker every week, every month. I might look at it every year, but that's about enough. And then it can create value on its own. If you have a business that's very volatile, very high risk, that's focused on today, but not on tomorrow, I don't get to sleep very well, because I have to keep a close eye on it. And that's not what I want to do. I want the management to keep a close eye on the long-term success of the business, so that I can take my hands off the wheel and get rich the easy way. Their future expectations, again, focus on long-term value creation. They acknowledge that revenue growth has moderated, but they believe in the potential of their ecosystem investments. They focus on agri-tech and global markets. They're preparing for future innovation and efficiency. Yeah, that could be quite interesting. They're committed to merchant support, short-term profit declines, focus on agri-tech. Okay, cool. First off, I want to look at, is this a great business or not, and whether or not I agree with this. I always like to look at liquidity, and we can go to our ratio radar, and we can look at their debt to equity. Extremely low. Extremely low. This means they have a lot of cash on hand and very, very little debt. So from a liquidity perspective, they're doing great. From a margin perspective, they're doing really well, 28.5. Net margin, that means from how much actually reaches investors. So gross margin is, well, out of every sale, they have to make certain costs to make that sale. That could be materials they have to buy. It could be people, if you are an employment agency, you have to pay the salaries of the people that you employ. For a business like this, it's mostly software, so it could be some kind of data center or some other kind of energy bill that you could have to pay before you can actually sell your product or services. The operating margin is what you have to pay to operate your own business after all those sales have happened. And then the net margin is actually the cash that can be transferred to you as an investor. And that's what you're interested in. You're always interested in the margin or in the statistics and the ratios that benefit you the most directly. And that margin is one of those. 28.5 is really, really good. Therefore, it's very, very green. If you look at their return on invested capital, it's also quite high, 28.35. I myself aim at a 15% return on capital for my own investments. They are beating me about almost 2 times as much. So this is a great place to store your cash if you just look at their return on invested capital. Now, let's see at their financial statements. I want to take a look at their cash flow. And specifically the free cash flow. And what you want to see is that it's very stable, or at least, and most importantly, you want to see it grow. Now, from a free cash flow perspective, this is on the far right. That's the oldest year, and the closer you get to the free cash flow, that's the youngest year. So that would be for 2024. 2025 isn't yet completed. We can look at it from a per quarter perspective, and then we can use the 2025 Q2 data. But for now, I'm interested in the year-on-year data, and you can see that it is. Is it stable? I wouldn't necessarily call it very stable. Let's look at their growth graphs. You can see that the revenue is actually absolutely explosive. Now, I think the revenue growth is looking good, and the free cash flow growth is looking good as well. Look, this is the big kicker. I think this is why it's discounted, and why we can't say it's a great business. They're handing out shares like crazy, even though they have a huge cash reserve. The reason why you would give out shares is to gain cash, and that cash, you can use that cash to invest in your business and grow your business. Now, they have a great return on invested capital, but the downside of handing out shares is that you as a shareholder get diluted. You are sharing the same pie with more people, and that means that your shares will be worth less. That's not what you want, and they seem to be doing this quite consistently, and they seem to be improving, or they're worsening their handing out of shares. That's not what I like to see, and I don't really understand why. They have their cash flow is huge. They have a lot of cash on hand, so why do they hand out shares? I like everything else I see, except that part, and this shows to me that I can't really, that I'm not on the same level as their management. I don't really understand why their management is doing this. And it could mean that they could make other decisions that are not in line with my best interests. So I would agree with, downgrading this from a great business to a good business, just based on this. We want to be highly, highly, highly critical in our analysis process. You never have all the information. You always get information that's outdated, because we can't look into the future, but there's a delay from when the business and the management knows about something and when you as a stockholder, as a shareholder, gets taken along in the journey. That delay gives you a disadvantage. So when you look at the data, you want to be extremely critical and make sure that you as a shareholder, as an investor, have a really high margin of safety. That means that your investment is better off for the long term. You sleep better at night. You want to look out for yourself first. So don't get taken along by a great story or by a great product. Look at what's in front of you. If you see something you don't like, you need to use it to devalue the company in your own head. You need to be intellectually honest when you look at the data. And to me, shares outstanding growing this exponentially without a good reason for them to do so downgrades this from a great business to a good business. Now, if we look from a price perspective, there are a few metrics that we use for this. First of all, the price to earnings ratio. The market average is 15. This is 8.71, which is a lot lower. The same for price to free cash flow. It's also a lot lower, roughly 8. Their earnings yield is basically the inverse of the price to earnings in relation to the stock price. And then you see that you can make an 11.5% return. Now, all these factors show that that it's priced very cheaply. Their free cash flow yield is a little bit lower. Their free cash flow it's quite unstable. So apparently this is a bad year for them, or a bad moment. And they don't have a dividend, so you don't get a dividend yield. Now, just looking at these, I would say it could be quite cheap. But what we want to look at to test this assumption is our own valuation lab. You can use 3 scenarios, and you can calculate revenue growth, the desired exit multiple, your desired rate of return, and how much you weigh each of these scenarios, and whether you want to base this on the earnings yield, on the free cash flow yield, or on the dividend yield. Now, this company doesn't pay a dividend. You wouldn't buy this for the dividend, so you wouldn't use the dividend yield. I think the free cash flow is very hard to predict, so I would base this on the earnings yield. I think that's the most reliable assumption that you can make. Historically, they've grown 55%. That's insane. We'll be doing an analysis for the next 10 years. You can't expect a business to grow at 50% for the next 10 years. That means they would double every 2 years or less than 2 years. That's not a sustainable growth path. So you want to be realistic here. I think in the best case scenario, let's say they manage to keep growing, but at 25% for 10 years. That's already incredible. And I would be willing to pay a higher multiple for that. So currently we're paying 8.7. I think there's a lot of fear around China. That's why it's being discounted. There's a lot of competition in China for e-commerce. Again, a reason why it's getting a lower multiple. But this is already priced in. Now, if they do manage to get 25% growth, it doesn't really matter whether or not the competition grows more or not. This is a great business to own. So I would be willing to pay a higher multiple, and we're going to base that off the market average, which is 15, and we will be paying more than 15 for the 25% growth, quite significantly, let's say 25. And I always aim at a 15% return, and we can use that for all scenarios. Whether or not the company is doing great, whether or not the company is doing bad, I want to get paid, and I want to get paid at least 15% every single year. That's why I use 15% for all 3 scenarios. Now for the revenue growth, in the normal case, I think we're going to look at a little bit more of an average scenario. And I think for the worst case, let's say they lose the race, they can barely grow at only 5%, and there's a lot of China fear still around, so we're going to even lower the exit multiple even more. And if we run the valuation, there's a massive upside. Massive upside. And I think that's mostly due to the multiple expansions. It's getting absolutely downgraded into the mud. Even in our worst case scenario, you're looking at a valuation of about 222 based on these assumptions. Now, once again, don't go out and buy something because some guy on the internet tells you something is a great investment. Do your own due diligence, do your own work. You can use our software to put in your own numbers and see what kind of valuations that you can come up with. But from a valuation perspective, it's a great business. Or it's a great price. I'm sorry. From a valuation perspective, this is a great price. Now, even though it's not a great business, and we just called it good business, having a really, really, really attractive price, that's what we're looking at now, could make this a great investment. But then we still want something that we can reliably predict for the future. And I think Pinduoduo, their cash flow, free cash flow, not very reliable. It's never been negative, but it's looking good. But mostly them handing out shares and me not understanding why management does this means that I can't reliably predict what they're going to do next and that they're going to make decisions in my best interest. And on top of that, I think the whole e-commerce battle in China, I'm willing to wait and see how it plays out. I can't predict how this will turn out in the future. Pinduoduo could be one of the winners. They could also lose. So from a business perspective, are they great? No. From a price perspective, amazing. From a predictability perspective, you can get better out there. So for me, this wouldn't be an investment. It would be something I would put on my watch list. Let's add it to our watch list. And I want to keep an eye out on this. I want to see how the competition in China develops. I want to see whether or not they continue handing out all these shares. And I want to see if their valuations change at all. Currently, not a great business, but it has a great price. But again, no reliability. Now, if we compare it to one of their biggest competitors, which is Alibaba, we see that they have grown. They have actually slunk, is that a word? They have decreased in value over the last 5 years by almost 41%. Recently, they've done quite a lot better, 94%. A little disclaimer, I've owned Alibaba for quite some time now, but we want to take a look at Alibaba. We just looked at Pinduoduo. We saw how they were doing. For us, it's not an investment, but something to keep an eye on, so we put it on our watch list. Now, Alibaba is something that we already own, but we want to look at this business from the same perspective. Are we buying a great business? Can we buy it at a great price? And can we reliably predict it for the future? Now, let's go to our AI analysis. It's not looking good. It's telling us it's not a great business. We can't buy it for a great price. And it's not very easy to reliably predict for the future. And I would be inclined to agree on all 3 points. The reason why, I bought it, they had a great free cash flow. Their free cash flow has basically disappeared. I think for a good reason, because they're investing in AI. And they only recently shown that they could get a great return on this investment by growing their AI business by 36%. But that's only recently. We don't know how this plays out. Their e-commerce business line is still depressed, or it's not doing as great. We talked about this for Pinduoduo as well. There's a lot of competition out there. Now, Alibaba, they also have their e-commerce, just as Pinduoduo does, but they also have cloud computing and AI products for consumers and businesses. So they are way more diversified, and their business model is a mix of their online retail and their cloud services. This is similar to Pinduoduo. They also earn money through transaction fees and advertising, but their cloud subscriptions is what sets them apart. And I think for future readiness, this is already looking better, and in my mind gives them a little bit of an edge over Pinduoduo. Now, can we see why they're not being, why they don't meet the great business quality? The revenue has grown only slightly. We want to see more growth. Their free cash flow growth has been negative. You want to see growth here as well. And the return on invested capital is also it's not very interesting. It's nothing to write home about. We're aiming at 15%. They're not beating that. Their cash to debt, however, is looking good. And this is an important difference from Pinduoduo. They don't hand out more shares. They actually buy back shares. And especially with their low valuations, great job. Great use of their cash. If you can buy your own stock at a low price, it means you believe in your own business. You don't dilute me as a shareholder, but you reward me as a shareholder through bad times. And it could also help drive up the share price. So from that perspective, great. Cash to debt perspective, great. Every other perspective, not looking too good. Now, can we find out why this is not a great price? So first up, we're going to look at the quick scorecard to get an overview of the valuation. PE above 15, above market average. So you're paying more than market average for a business that doesn't grow too much and doesn't have a great return on invested capital. The price to free cash flow is even higher, even worse. Their earnings yield is 5.77. Again, you want 15%, or I aim at 15%. Market average historically has been about 7 to 8%. They're below that. Free cash flow yield massively below that. They do pay a dividend. Another thing that sets them apart from Pinduoduo, if you're interested in receiving a dividend, Alibaba is the place to be. So this already tells me from a valuation perspective, they're more expensive than Pinduoduo. And let's put them through our valuation lab. If these are the assumptions that we make about the business for Alibaba, we're still looking at a massive upside. And it would mean we can get it at a great price, and would actually disagree with our AI analysis. But this is on the assumption that they keep growing quite strongly. Let's say what will they use? Yeah, I think they're using, not looking too bad. So from a price perspective, I would say they're looking good. From a reliability perspective, Alibaba, they have more business lines, which is a little harder to predict, but I think they're less dependable on just the e-commerce section, whereas Pinduoduo is dependent on the e-commerce section and the entire competitive space that it is. It makes it very hard to predict what will happen and who will come out on top. Alibaba also being active in the cloud computing and AI space make them a little bit more dependable, a little more reliable, because you can depend on their other business lines to generate revenue. And from a trend perspective, I think the whole AI and cloud computing trend is going to continue. And over here in the West, we only look at the US tech stocks. We look at Amazon. I think Alibaba is the Amazon of the East. And what was I saying? Yeah, for the West, I think Amazon is a big player. And if we look at cloud services, we look at Amazon. I think if you live over in Asia and in the East, you look out to Alibaba. I think that's what you rely on and depend on. And China is a huge player in Asia. They will continue to be a huge player in Asia. They're a huge player in Africa, in India, and those are all growth markets. And I think as long as they grow, both Alibaba but also Pinduoduo could benefit there quite massively. So they have a lot of room for expansion. I think their home e-commerce, I think at their at home in China, their whole e-commerce debacle is what they got to tackle first, and I think that's the most important dilemma or risk that you need to solve, or that China needs to solve if you want to invest in any one of those two stocks. From a reliability perspective, I would give it to Alibaba and say this is the more reliable business than compared to Pinduoduo. So Alibaba is the more reliable business compared to Pinduoduo. Now, if we compare the two, they're both Chinese e-commerce stocks. One is only reliant on e-commerce, has seen massive growth, but the growth is decreasing. The other is already huge, is the incumbent, has been around the block. They don't only have the e-commerce section, but they also have their AI and cloud computing section, which makes them a huge player, not only in e-commerce, but internationally in the entire cloud space around Asia, Africa, India. Pinduoduo, it's not a great business, or it's just a good business. From a price perspective, they're hugely undervalued, but they're very hard to predict because it's very hard to see what's going on in China and who's winning the e-commerce race. Then if we look at Alibaba, from a business perspective, they're more reliable, but they grow less. Their return on invested capital is lower. The only saving grace is that they buy back more shares, whereas Pinduoduo hands out shares, and that's not what you want to see. From a valuation perspective, Pinduoduo is incredibly cheap, and Alibaba seems to be cheap as well, but a little bit less cheap than Pinduoduo. From a predictability perspective, Pinduoduo is very hard to predict due to the Chinese e-commerce battle that's going on, and them being incredibly dependent on the outcome of that whole battle going on there. Whereas Alibaba is a lot more diversified, and they have a big future growth industry in AI and cloud computing. I would hand it, I'm a little bit biased, I own Alibaba shares, but I would say Alibaba is the better business to own. But Pinduoduo does offer an opportunity at the incredibly low valuations. So I would definitely put that on your watch list as well.